Welcome back to Bazaar Morning Call. As promised, now we're going to talk about the government's a production incentive scheme, production-linked incentive scheme, and the impact it would have on several companies. Joining us now is Mathew Job, who is the CEO at Crompton Consumer. Remember, the government's production-linked incentive scheme has around 6,200 crore rupees that has been set aside purely for the white goods space, including products like air conditioners and LED lights. Mathew Job joins in now to give us what the impact of this could be and how it could even benefit the company like Crompton Consumer. Mathew, thanks so much for being with us on CNBC-TV18. I just want to understand on this PLI scheme itself, would the company be interested? Because many companies that we've spoken to in the past have indicated that there is a lot of export opportunity because of this scheme, and they would even look to put in some greenfield projects too. What could the opportunity be for a company like yours, and what are the challenges?
Yeah, we already manufacture quite a large portion of our LED lighting products in-house. At the moment, we are trying to get a greater clarity in terms of how this PLI scheme is going to work, what kind of incentives are available, what are the conditions that need to be met. We feel that this kind of a program can support and help the LED production of LED lighting products within India and make us even more competitive. I think if I look at the way our LED capabilities have evolved over the past few years, the fact remains that most of the LED products we sell in India today are made within India and within our own factories, for example, for Crompton. I think this will make us even more competitive with respect to being one of the most competitive producers globally. So that is how we are looking at it. Of course, we need to get greater clarity in terms of, as I mentioned, what kind of incentives are available, how much would that work to, what kind of conditions are required to be met, and so on and so forth. So I think it will take at least another month to 2 months to get full clarity in terms of how this is going to work.
Okay, but Mathew, you may have had already conversations with the government. Any early contours and any early money that you have set aside for it? Some target in terms of capex?
So nothing yet, because of course the industry body itself is in conversation with the government to get greater clarity of the program. So while we know that there is an incentive available, I think the details still need to be made clear. We have had some clarifications have been sought from the ministry, and we are waiting for greater clarity before we can chart out our path going ahead.
Money in your head in terms of I will put up this much equity, I will put up this much debt, this will be my size.
See, I think it's beyond. We are not just looking at it in context of the PLI program. As a company, we have prepared or are also in the process of preparing what I call as a medium-term sourcing footprint, which obviously requires us to put in additional capacities in the next 3 to 4 years. This program could add or could make that program even more stronger. But I think we don't see at this moment a fundamental requirement to change what we have already planned.
Fair enough, Mathew. Now that's the future. Let me come to the present, the here and now.
Yeah.
Tell us about the demand situation and the recovery. So now with, of course, festive season, etc., if you could tell us, year to date, April to now, whether you're back to 80 or 90% of pre-COVID levels, and with the trends, how do you see the overall aggregate top line for the present year?
Right. See, obviously, like when we spoke the last time, the first quarter was obviously a washout because 2 out of 3 months had virtually no activity. So business in the first quarter was roughly down 50% versus last year. I'm talking about the primary sales of the company. But if I look at most of our segments that we operate in terms of consumer offtake, the first quarter was down 80%. Second quarter, if I see, our business had grown, roughly in double digits and low double digits. But if I look at the market data, which is available in terms of third-party data in terms of consumer offtakes, it was still minus 10 over last year. In the current quarter, and we see the trend of gradual increase continuing. So, like I said, second quarter was much better than the first. In the third quarter, we start to see a slight further improvement. I would say, in terms of overall market demand, I would say roughly about anywhere between 90 to 95% of last year levels is what I would peg the overall demand situation at. But that doesn't mean every company is going to be in that space. For example, the last quarter, while the market was, the overall demand was down 10% on last year, most of the leading companies in our space did show high single to low double-digit growth. So I expect that a similar trend could continue for now. But just one thing you need to keep in mind that at this moment, we see significant run-up of commodity costs. So if you look at commodity the metals, if you look at plastics, the costs have really run up in the last few days, the last few weeks. So that is going to create some headwinds, for this recovery that seems to be happening on a broad scale. That's what I would say.
Yeah, actually, I have too many questions now in my head. But first, since you spoke about inflation, can you tell us what are the products? Are there some products that are not available at all? What is the overall cost inflation?
If I look at the categories we are in, the inflation, I would say, is anywhere between 10 to 20%. The cost inflation. And if I look, you would have also done this research and found that for the consumer durable industry as a whole, including consumer electricals, we are staring at somewhere between 10 to 20% cost push. And now this is on account of commodities like copper. Plastics have run up a lot. For example, ABS, the cost has almost doubled. It's not only in terms of cost. Availability has become an issue. Availability of some ICs have become an issue, for example. And it's not an India phenomenon, it's a global phenomenon, and because these costs are very much linked to global markets.
Yeah, so what will it mean for you? Will you be passing on, so will all your products be 10% more expensive? And since you're saying it is not even available, what will be the capacity utilization in your own plant?
See, the way we are looking at it is, I think because of our superior competitive position in terms of our balance sheet strength, I think we are better placed than many others to be able to secure the demand, to secure the supply that we need to cater to demand. Obviously, we are not immune from these cost increases. So while we see 10 to 20% cost increase, we will need to factor in a couple of things: the overall competitive situation, the overall demand situation. So I don't foresee that automatically it will be possible to pass on all the entire increase to the consumer. Part of it will have to be passed on. So you will see that most companies have already started announcing some level of cost, price increases. But we already, as I mentioned before, we have in some of our previous discussions, we also have a very strong cost initiative which has been running for many years. And that, I believe, will help us also to cushion some of this impact, because our estimate is this inflation is likely to last, at least till Q1 next year. And then, you could see some kind of softening of commodity prices. So we cannot have prices going up and down for our products, quarter to quarter. So we would be, of course, more measured. We will see what the market can afford and then manage, the whole equation accordingly. Yeah, that's what I would say.
I have just, one or two questions in this, Mathew. Since you're not going to run away with the price increase immediately, is that going to pressure your margins? And you mentioned ICs. That brings me back to a conversation we're having with the auto guys. Is this chips that are becoming a problem for you as well? Because they're not getting chips because the telecom guys are using the chips for 5G.
Yeah, you're right. You see, what's happening is also because of the ongoing issues between the US and China, for example. There is obviously a shortage of chips in many of the places, and obviously the chips are being diverted. I would say the IC manufacturers are actually diverting their capacity to segments which inherently have higher margin for them. So obviously some of the segments are under pressure. I think lighting is one such industry which requires a large number of chips for LED products, but where typically the margins of the suppliers wouldn't be very high. So I think there is going to be a short-term impact before supply ramps up to meet the demand, and that means that obviously only those companies who have a better buying power, who have better balance sheet, will be able to manage to secure the supplies. The others might find it more difficult. So that, I think, is
got the point. If you can, we are running out of time. Just give us an idea, H2, what may be the revenue and EBITDA?
I would expect, we don't want to give, we don't give any forward-looking guidance. I think, our objective is to at least to deliver the kind of growth we have seen in Q2. And of course, that assumes that, there is no further worsening of the COVID situation, that these commodity prices running up won't create such large headwinds that demand would be seriously impacted. So based on the assumption, our objective is to keep the kind of growth we have got in Q2 going for the phase 2 as well.
Yeah. Yes, I agree with you that serious case of stagflation should not happen. Thank you very much, Matthew, for joining us.
Thank you. Thank you. Nice to meet you.
A quick break, and then we have some interesting guests joining us.